Woman, an in-depth exploration of the world of women today with Sandra Elkin.
Good evening and welcome. Recently on Woman, we devoted a program to women and insurance. On that program, we discussed many areas in which my guest felt women were being discriminated against. Tonight, we have two representatives of the insurance industry who will explain some of the practices, talk about progress that has been made, and the difficulties in making further progress. With me tonight is Robert Waldron, Manager of Press Relations for the Health Insurance Institute and Institute of Life Insurance. Also Barbara Lautzenheiser, who is currently a Vice President and Actuary of Bankers Life of Nebraska. She is also a Fellow of the Society of Actuaries, which has 2,300 members in North America, and Barbara is one of the 43 female members. Welcome to Women, to you both.
Thank you.
Bob, do people generally trust insurance companies?
Yes, I think so. They have to, in a way. The contracts that they write, especially life insurance contracts, are going to endure for 60, perhaps more years. And they ought to, because there's a great body of law that regulates them and insists that they be financially responsible. In fact, it's against the law for an insurance company to go broke. And there's a tradition that goes back a long time in the insurance business. The people in it generally adhere to fairly high principles.
How many life insurance companies are there in the United States?
About 1,800, aren't there?
Right. That's incredible. Who are the people who are watchdogs of the industry? Who regulates it?
It's regulated by the state, by state insurance commissioners, but also it has to be responsive to the total body of law, which includes the Civil Rights Act, which includes a lot of federal law, which applies generally to everybody. The fiduciary standards, that is financial good faith, you're handling somebody else's money, have been set, I think, by Justice Benjamin Cardozo, who insisted on a standard of fiduciary responsibility for life insurance companies much higher than those who handle money for so short a period of time, like a bank. So we're funding in a benefit which may not come into play for a half century.
Right. This is really the reason that the regulatory body is absolutely necessary, and the emphasis is on solvency is because of the long-term aspects of insurance contracts and the fact that for a child age 0 it may not be payable for maybe even 100 years.
What about the EEOC and its guidelines? First explain what the EEOC is, Barbara, would you?
The EEOC is the Equal Employment Opportunity Commission, which is regulating the Civil Rights Act of 1964. And they have developed guidelines which employers are to follow in order to not discriminate. And these guidelines are actually now being interpreted by federal courts. They are not specifically legal until the courts rule that they are reasonable in their guidelines and aspects.
There are about 50 different insurance laws in 50 different states, is that right?
Well, there are 50 different jurisdictions.
Yeah.
And there, of course, is the federal jurisdiction where we cross over into areas where the federal government has an interest and where laws have been passed.
Would the industry prefer that all the states have one set of guidelines?
Well, I think that there would be a preference if all of the guidelines were consistent, and there is a National Association of Insurance Commissioners which do get together to talk about consistency between the states. But there is some debate within the insurance industry itself as to whether or not federal regulation would be preferable to the 50 different bodies, because each company that does do business in each state is regulated by that state. So if a company were licensed to write business in, say, 44 states, then they would have to be regulated by the 44 states, and of course the inconsistencies are part of that problem.
Is there any advantage to the customer in having this?
It would probably be 6 of one and half a dozen of the other. If you have 50 jurisdictions, the opportunities are 50 to 1 that you'll get one outfit who will innovate and concern itself with the consumer quite a bit. If you have only one, you've got only one chance of that. And regulatory agencies in the hands of the federal government unfortunately have a habit of getting rather rigid. I think the 50 have a tendency to pollinate each other, spread ideas around. But as I say, it might be better for a federal regulatory agency to do it. There is a debate within the industry,
Right.
as Barbara said.
From the consistency standpoint, the one federal regulatory body would be preferable. But again, if that turned out to be something that really did not meet the consumer's need, then of course it's not preferable, and the fact that there are various 50 different ones working on it,
nutshell.
some they control each other, so to speak, to a certain extent.
In a nutshell, it might be tidier, but it might not be better.
Each premium has each policy has a premium tax. Is this money spent to regulate the industry?
Some of it, not all of it. The states have used this revenue for general revenues and to, buy other things.
Should it be?
Well, it would be much preferable from the standpoint of state regulation if more of that premium tax were used for insurance regulation, because this is one of the difficulties in some of the states, is that they cannot pay salaries adequate enough to get highly competent people there. So if more of that premium tax were available for state regulation, I think that the regulation, at least from the standpoint of whether or not salaries really is equated with more competent people, I don't know, but at least would help, as they do have backlogs in getting some of their work done. And of course more people would help along that line too, and if they had more money to work with, naturally I would think that they could have better regulation also.
What do you feel that the insurance industry's attitude has been toward women up until this point?
I think you'd have to go back a little further in time to find the antediluvian attitude that some suggest that we have. Right now, the attitude is one of trying to accommodate its business to the needs of a growing new market of women who are becoming more and more concerned with the economic world and more aware of their economic status, and trying to accommodate itself also to a growing body of law and regulation that is dealing with this issue of discrimination.
I think they have seen that there is a market that is really very much untapped. I think only about 20% of the business that is sold is currently sold to women, and a lot of that is sold to married women, and the professional women just don't have the coverage that they need. I think that the fact that there are many divorced women and widowed women who have children who have a need there, but they've traditionally thought of themselves as not being an economic body, they have not thought about it, and I think this is a totally untapped market, which I think that the insurance industry is going to be going into. I know in the disability income field there has been some tendency in the past to not think of the female as a working female, or that it was a temporary thing, she only did it if she wanted to. That's changing because of course more women are working and they're staying in the working force a great deal longer, and the insurance companies are changing along with it. And since more women are continuing to work, there's less hesitancy on the part of the insurance company to not want to issue the insurance. If they feel there really is an insurable risk there, then they do want to sell their product. They're in the business of selling insurance and attempting to fill a social need. And so when they see that need growing, they're going to move into it. And we found some literature from some insurance companies specifically pointing out, women, you need this kind of insurance.
What are some other practical ways that they're proving their change in attitude? I know you talked earlier about a sex discrimination committee.
Yes, the Association of the American Life Insurance Association and Health Insurance Association has formed a sex equality or sex discrimination, depending on how you want to look at it, committee, which has been working since, I think, December of 1973, wasn't it, and going over the various issues and making recommendations to insurance companies as to what they should be doing, what coverages they should be stressing, and where they are possibly discriminatory and should be changing.
So then you really freely say there was discrimination. There's a tremendous effort being made to change this, evidently.
Well, there was. You have to define discrimination. There were distinctions made between women, and there still are, and men, because they have different life experiences. For example, women live longer, about 7 years longer. The result is that their annuities cost more, because you're going to have to simply provide a larger fund to provide the income over the non-working portion of a woman's life. By the same token, and on the flip side of that coin, their longer life results in a lower rate for life insurance. And this, we feel, is completely fair, that each classification of risk, and risks are classified not only by sex, but they're classified by age, by occupation, should bear the costs and gain the benefits of its own experience. This is a principle of equity that the insurance companies not only try to follow, but they're obliged to follow.
There are some people within the industry who would like a sort of unisex rate.
Well, there have been some who feel that this would be an easy solution, or at least this is my interpretation of why they are stressing a unisex table. It is very easy to combine the data for males and females, just like you could combine the data for various ages and create just one table. As a matter of fact, that's the way the tables were initially. And back in the 50s, they began saying, no, there definitely is lower mortality for women, and I think we are discriminating against women by not having a separate table, since their life insurance costs are considerably less. So at that point in time, we began separating the tables. And so now this is one of the areas where some females are feeling that we are discriminating against them by not having a unisex table. But this unisex table works both ways. As Bob has pointed out, a unisex mortality table would provide for higher costs for annuities because the woman lives longer, but it also provides lower costs for life insurance for the same reason, because she lives longer. Where you were to take a unisex table, you would have to be combining both the males and the females together, and it would mean that in the case of life insurance, women would be subsidizing the costs of men, but in the annuity end, the men would be subsidizing the costs of women. And of course, from an actuarial standpoint, it's much preferable to have the person who receives the benefit actually pay according to what his costs are. And when you do it that way, then you have this freedom of choice. If it were to turn around that we were to find that all of a sudden there's a cure for cardiovascular diseases, and the men started living longer, then it would turn tables. But I think we need the opportunity to do that and to be able to do that. And in order to watch these changes as they occur and to take care of them, you have to have the separate tables.
How long does it take the industry to catch up with a reverse in a social trend?
Well, first it has to identify it as a trend. It wants to be sure that it's not reacting to something that's going to happen for a day and a half.
How does it do that? I mean, how can you tell the difference between a fad and a trend?
There's only one way to do that, and that's to watch it. And if it endures long enough, and if it appears that it's going to be a new component with which we'll have to deal, then we'll undertake the efforts to deal with it. The issue of women, I suppose we could have acted early in the 60s. But it simply hadn't become that much of an issue. 10 years ago, some of the things some of the stereotypes that are in the old manuals were in fact true. Many women did not go into the workforce as a career. I think the women's movement is no more than about 8 years old now. The consciousness raising, I don't know when the first bra was burned on the Asbury Park boardwalk, but I think you can date the women's consciousness raising movement from that point. I think it took 2 or 3 years before women themselves looked at it seriously and began to say, hey, I am being discriminated against. And then it took the men a couple of months to kind of turn around and say, yeah, I guess you're right. And all of these things do take time. Unfortunately, in the interval, people who feel themselves abused by the past system have to wait until the new system comes into force. But we are making strenuous efforts to bring that kind of a system into force. I won't say we've been especially speedy. Life insurance companies and health insurance companies do not have a hair-like reputation.
Well, their product is so long range, again, because an insurance contract may not pay off for a very long period of time. Similarly with disability income, you've got a long-term contract, and anytime you are responsible for rating or developing the premium or cost for a contract, you are very conscious of the fact that you want equitable cost. You again want the person who receives the benefit to pay for it. So you want to make sure that when you do see a trend, it really is a trend. It is not just a random fluctuation that is going to change. And because of this tendency to always check trends, I think this does slow insurance companies down. And they tend to want to wait and look to make sure that what they are doing is the right thing, and that some 20 or 30 years down the road, they haven't really discriminated against without knowing it. And
And by another set of standards, by, let's say, a political set of standards, we could be justly accused under those kind of standards of being a mite tardy. But by insurance company standards, we think we're moving along at the proper rate of deliberate speed. Some of the things that have happened in the last couple of years have happened rather quickly by insurance company standards. For example, in disability insurance. 2 years ago, I don't think that a woman could buy disability benefits that would endure beyond 5 years. Now she can buy them up to 65, as a man can. So accessibility to the product, those barriers have gone down. They've gone down in group insurance, and I expect that they'll go down pretty darn quickly in individual insurance, which has a tendency to follow group insurance. Group insurance is the pioneer. That's where we get our experience. The individual experience is then transferred from that. We can make some judgments on what the costs are going to be.
Barbara, there's a thing that I would like you to define. You seem like the perfect person to do it. Would you talk about actuary tables and what they actually are, how they're used, and what goes into making up a table?
Well, there are various types of actuarial tables, but the one for life insurance and for annuity payments is a mortality table, which gives the probability of a person dying each year for each age. When you combine those probabilities of dying with interest that is discounted, you come up with the single cost for a payment of the probability of having to pay $1 or $1,000, whatever the benefit is, at any particular point in time. Similarly, for a disability income contract, we are talking about a morbidity table. In that particular instance, instead of the probability of dying, you are adding the probability of becoming disabled, and then down the road from that, once a person is disabled, the probability of his recovering or dying. So you have multiple probabilities developed into a morbidity table. But they are merely sets of probabilities, which when you combine with interest, because the cost of having to pay $1 today, of course, is quite different from the cost of having to pay $1 30 years down the road. You combine those two together and you end up with the cost of life insurance or the cost of disability income insurance.
See, probability can't work unless you have large numbers that work. Anybody who's ever shot a game of dice knows that. All of those numbers will turn up in direct relationship to the odds on them, only if you roll those dice about 1,000 times. So you don't deal with individuals in discovering the probabilities, and you don't deal with individuals in discovering the experience that you face. You deal with large
Some
groups
people,
of people.
though, who are critics of the industry suggest that there are other ways to figure things. For instance, like in health insurance, you should take family medical history, personal medical history, that kind of thing into consideration. It would be more accurate, is that?
Now you are talking about the type of classifications, and again, what you have to always be talking about are large numbers. You start with a very large body. Again, you had a unisex table for life insurance, and you begin then saying, well, maybe there is a difference between the sexes, so let's break the two tables out and see if there is a difference. And you find at some point, yes, there is a definite difference. Now, you could say maybe there is a difference now from smoking. I understand that some of the automobile insurance companies are giving different rates for people who smoke as opposed to people who do not smoke. If you can develop a body of data from a large enough exposure, a large enough group, again, because it only works in large numbers. You cannot apply insurance theory or contingencies on one or two people. It just doesn't work that way. And so if you have a large enough body to be credible, to be valid from year to year, again, so that it becomes a trend, and you can see differences, and it may be you see that people who are 5 foot tall have a different mortality than people who are 10 feet tall. I'm sure they've run that and have found that's not true. There is truth as far as weight is concerned. People who are overweight have been found to have higher mortality rates, and this, of course, then develops the substandard rating. One of the things when you are talking about large numbers that you try to do is develop data for a homogeneous group. You want to make sure everyone is of the same status. We don't want people who are about to die in with the same group of people who are very healthy, because that's not really fair cost to the person who is healthy.
This goes to this issue of equity. Let's try to reduce it to a very simple example. As a consumer, I wouldn't want to be classified in the same group of people paying the same amount of money because I'm a fairly steady individual and I live fairly moderately. I have only a few vices, smoking, things like that, with a fellow who is who risks his skin every other day. Let's say he's an overweight trapeze artist who drinks on the job and swims in shark-infested waters for his hobby. I don't want to pay the same rate as he does. I want him to belong to a group that is similarly situated. Otherwise, I'm being discriminated against as to cost. This whole principle of equity pervades the insurance business, and it says, in effect, that discrimination consists of two things, or two aspects. You are being discriminated against if in equal circumstances you are being charged more. But if in unequal circumstances you're being charged the same, you're also being discriminated against.
This is a point that was brought out in the Griggs versus Duke Power Company case in Washington State, where they said that treating unequal people equally was just as discriminatory as treating unequal people, got that backwards, equal people unequally. Both types are discrimination. What equity requires is, again, that you charge according to whatever the cost is for people in a similar classification.
Let's run down some of the things that people say about disability insurance, and just, you know, as I read them off, you give me the answers to them. Is it true that rates are higher for women?
Yes, it is true that rates are higher for women. It is a statistically proven fact that the rates, according to insurance statistics that have been taken for policies that have already been issued, that the annual claim costs are about 2 times as high as they are for males. This is also evident in some of the morbidity statistics that the Metropolitan Insurance Company has done on their own personnel. This is, if you take a look at it by causes, you find that even the causes are different for women's disabilities as opposed to men's disability. The causes are more respiratory diseases and urogenitory diseases, this type of thing, whereas the men's are more serious type of diseases, more involved with cardiovascular diseases. And so you find that even the monthly rates of disability are quite different. In some instances, the annual duration of a sickness or a disability for a female is in fact less than it is for a male. But the incidence of that disability is so much higher that it makes up for it, and hence the claim costs are quite a bit higher. So it's a reasonable thing that the rates are higher.
Is the definition of disability different?
There have been some different definitions of disability. One is for your own regular occupation, and another is for any occupation. For some of the lower male occupational groups, the more strenuous, there's also an any occupation definition. However, this too is changing, and they are now starting to issue the same occupation definitions for women in the same circumstances as men.
Is the length of time covered different?
Again, this is what Bob was talking about as far as the benefit period is concerned. At one time, it was allowed only for 5 or 10 years for females. Now the benefits can go to 65 or lifetime as far as accident coverage is concerned.
Is there a longer waiting period before you can receive payment if you're female?
There had been some discrimination.
Yeah, those qualifications
in this area.
were there. We have to concede that. And again, it was
But
based
this is
upon
no
the
longer
fear
true,
of
you're
insurance
saying.
companies that they would be selected against by women. We have to talk about anti-selection, I think.
Yeah, let's hang on with that though for a minute and finish up on the disability insurance. This
Yeah,
is
this
all
is
changed
changing.
now. The only one you claim is left is the rate difference?
Well, there are still some companies that do have the other differentiations. Don't misunderstand me. It is not something that has done overnight. This is something that we in the American Life Insurance Association and the Health Insurance Association really are going to try to convince these insurance companies that they should do. Of course, they do have the freedom of choice to do or not to do. But we are putting out recommendations. This task force, this committee that we were talking about earlier, has issued a statement saying that they really should not discriminate in these senses. But we are standing pat on the area of the difference in rates because they are statistically proven that they are different.
Some
Another-
of these qualifications in insurance policies are designed to reduce costs and to equalize costs between men and women so that the same policy be written by, let's say, an employer. And in effect, by doing this, by giving some windage in this direction, you equalize their employment opportunity as far as the employer is concerned. Many of these policies are written this way because that's the way an employer wants it, especially in the group area, or because an employer and a union agree that this is the way we want it. We'll equalize these costs by putting in these exceptions on the female side so that we equalize the experience.
One of the other areas of major criticism is health insurance, is it not?
As far as
Pregnancy.
is concerned, yes. This has become a very important issue, and of course there are a lot of court cases coming out on it now. This gets into what Bob was talking about in the anti-selection. From an individual disability income contract standpoint, I think that not covering pregnancy is a very important thing. I, as a female, would not want to buy a policy from a company that did cover it, because what could happen is a female who knew she was going to want the benefits could buy the contract, then become pregnant, receive the benefits, and then drop the contract. And those costs would have to be built into the policies of those who continue to keep the contracts. So in my opinion, it is extremely discriminatory against other females who do not want to have children.
Or females who are past the
Past the
childbearing
childbearing age, that is correct. Again, we should be able to have the particular policies that cover the benefits we want and not be forced to bear the costs of other people for a benefit we would not want to receive.
This would become particularly important in the group area, where you have an employee force. And if you did this, literally, you would be subsidizing some women who wanted to have children. They might even join that employee force just to get those benefits, then leave that force, collect that disability, and never go back to work again. And the workers remaining at the force would pay for that.
Is pregnancy considered an illness by the industry?
Pregnancy is not considered an illness by the industry. I think that pregnancy has been considered an illness by some of the court cases. There are also other court cases. I believe Newman versus Delta Airlines indicated it was not an illness. In fact, it was a state of health as opposed to being a state of illness. There are insurance companies that do write pregnancy as an illness, but this then does increase the cost to the employer quite substantially, depending upon how many young females he has in the workforce. It can be anywhere from, I believe the average cost they say is a 40 to 50% of the total benefit package would be for pregnancy treated as an illness. In the GE case, I believe the actuary indicated there that it would be a 300 to a 330% increase. And these are substantial costs that, of course, if the employer is going to incur.
Barbara, I'm sorry we've run out of time. I thank you both for being here. Good night, and thank you for watching.